Okay, now we've looked at the 10 rules for creating a forecast you can trust. So now what I want to do is weave that into what I like to call the recipe for financial forecasting, or the plan, create, present approach to creating a reliable financial forecast. And it's important that we do it in this order, that we're planning what we're trying to accomplish, then we're doing the work of creation, the work of creating the forecast, and then the presentation, whether that's just for our own consumption to make sure that we're gathering the insight from the forecast, or whether we have a partner or lenders or other who we're going to be sharing it with. We want to go about this process of plan, create, present. And I'll talk about each one of these in a little more detail in just a minute, but in the plan phase, we're setting the objectives. Here's what we're trying to accomplish. Sometimes it's here's some of the questions that we want the forecast to answer for, some of the things that we're focusing on, some of the things that we're driving toward. We want to decide on the historical and future periods to present. So I said that we don't start a forecasting process with a blank slate. We're going to bring in some historical financial information first. And we're going to do that by, generally speaking, we're going to do that in 12 to 18 months of monthly historical financial statements. And then we're going to create a forecast for the coming 12 to 18 months. Now, I do make some exceptions, especially if you're getting started now and you're going to get started for your eyes only. One of the things that we do to help get started quickly is we condense those periods so that we might just look at the last 6 months of historical results and do a forecast for the next 6 months. Then we're going to identify the key drivers that are both financial and non-financial. Like we did in the Chewy's example where we were forecasting revenues and we're using our two numbers approach. In that case, it was number of restaurants open at the end of the period times the average revenue per restaurant. So average revenue per restaurant is a financial measure. Number of restaurants open at the end of the period is non-financial. Same way if you had a professional services firm where you were, say, billing by the hour, you would have hours incurred at a big picture overall company level. That's a non-financial measure times average billing rate, which would be the financial, in order to arrive at revenues. And we're doing that across all our assumptions. So I'm generally identifying that two-number exercise as how we identify the key drivers. Then in the creation phase is where we're going to actually go and start gathering that data. Right? So in the professional services firm that's billing by the hour, we're going to go to the time tracking system in order to be able to gather where those hours are coming from. In a retailer that might be using number of customers times average ticket, might be going to the POS system to see either the number of customer transactions or other information that we need that's primarily non-financial. Because the financial data is going to come out of the accounting system. In most systems today, you can export a series or a time frame of financial statements where it exports it for you month by month by month. Then we're going to do some discussion about where the business is going, so that if you had a partner, as an example, you'd be looking at questions of where are we taking the business? Are we doing anything different in the future than we're doing right now? Like in our construction example that we're going to look at in the next module, they were putting together a forecast, and they were going to be doing a lot of the same kind of projects that they had been doing in the past, but they were also going to be bidding on some much larger, very different kind of contracts and projects going forward. So they had to consider that as they were doing the longer term portion of their forecast. And then we want to do the hard work, the part that takes a little time, and that's the creating of the forecast, especially if you're doing it for the first time. There is a good bit of work in that process, and we're going to talk about that. Then in the present phase is where we're make sure that we're looking at the results of our forecast, which is a P&L, balance sheet, and cash flow, and we're condensing that into a 2-minute summary so we make sure we get the insight from that forecast. Then we're always, whenever we do present the numbers, we put them in the context of historical. So it's like actual by month, and then forecast. You'd be amazed at the kind of insight and information you get about trends up and down the profitability section and cash flow when you look at historicals and forecasts together. Same way too when you're looking at your actual financials. Instead of just looking at a single month, which is generally speaking a bad practice, look at, if it's you're looking at June results, look at January, February, March, April, May, June, all next to each other. Some trends will jump out at you. Sometimes some poor accounting will jump out at you. But it's a fantastic way to make sure that you really understand what the numbers are doing and saying and what the trends are. Then we're going to make the forecast a part of our monthly financial rhythm, and we're going to go through that again, exactly how we do that in the next module. Okay, so now a little bit more detail in the plan phase. When we're setting the objectives, what I'm talking about is big picture, why are we forecasting? We know that the reason we're forecasting is we're trying to create a bigger and brighter financial future because we're trying to drive profitability, cash flow, and ultimately our net worth. And we also have some very specific questions we want to get, like what do we expect profitability to be over the next 3 months? Are we going to have to borrow money in order to meet our growth plans over the next 3 months? We want to set out the objectives and the questions so that when we're done with the forecast, we can loop back and we have answers that we're either how we achieve the objective we set out or how it provides us an answer for the very specific questions that we're trying to answer. And then when we're deciding on the historical and future periods, if you're just getting started, I encourage you to just go ahead and look at the last 6 months of actual results. And then we're going to do the forecast for just the next 6 months. So generally speaking, I would always go back, say 12 to 18 months, and then I would forecast 12 to 18 months. But when you're just getting started, it's a good idea to just shrink those periods a little bit so that you don't overwhelm yourself with detail. And then as you're going through this process of trying to get the 2 numbers for every assumption, I want to make sure that you send me an email, contact me if you struggle with that, because it's such a very, very, very important part of this forecasting process that you really hone in on the key drivers, especially when you're using that 2 numbers test. Same thing when you're going about the effort to gather the financial and non-financial data. The financial information, from QuickBooks or Xero for some of the other systems is pretty straightforward now. They can export that for you really easy, both P&L and balance sheet. And then the way I generally set it up is I allow my if I'm doing it in a spreadsheet, I create the formulas in the spreadsheet to drive the statement of cash flows. And if I got it in forecasting software, then obviously it's going to do it for me. And then when I talk about discussing where the business is going, that's really you sitting down and thinking about where you're taking the business, especially for the forecast period that's, say, out 6 to 12 months once you get up and running with those periods. And if you got a partner, you got to sit down and talk about where we're going with this thing. And one of the interesting things that you're going to find is that you're going to learn a whole lot more about your business model. It's going to force you to have some conversations that maybe you haven't been having. And then the work of creating, which I'm going to talk a little bit about here in a minute, is where the hard work is. That's another one where I encourage you to send me a note if you're having trouble, because this is where you're actually got to get up and running. You got to make the decision about whether we can use a spreadsheet or forecasting software. There really is a good bit of work, especially if you're not generally or haven't grown up on the financial side of the business. And then that 2-minute summary, it just is very, very important as well. And that's really where what I'd like you to take away from that whole thing is that when you got a whole bunch of numbers, whether they're historical or looking forward, when you can condense what they're saying to a 2-minute conversation where you can communicate what it's saying, like say to a partner or even to a spouse, that's when you know you're really getting some understanding about what's going on with the numbers. All right, and then I'm going to talk more about showing historical and forecast results as we look at our example. And also I'm going to talk a little bit more in the next module when we walk through how we kind of revisit how we work this forecast process into our monthly financial rhythm, which is all about starting with goals and targets, the monitor function where we're bringing those numbers together, both historical and forecast, to make better decisions, and then making the changes in the business that we need in order to take the business where we want it to go. So let's just look at a few of the details when I talk about some of the assumptions we're going to be making in the creation phase of the forecast. When you've got a spreadsheet or something else in front of you, and you're actually going to say, okay, now I've got an income statement or a P&L. I've got to make assumptions about revenues. I got to make assumptions about cost of goods sold so that I have a gross profit and I can calculate a gross profit margin. I've got to make assumptions about my operating expenses. In some cases, that'll come from a budget, so long as that budget is realistic. So creating a budget, at the beginning of the year and then never looking at it again is not a good practice. And then, of course, the bottom line on a P&L is that net income number, which is really just a summary of what you've created with revenues, cost of goods sold, and operating expenses. So with revenues, I've talked a whole lot so far about that 2-number approach. That's how you're going to get your revenues. Cost of goods sold, what I would generally do is I would take, if I had a gross margin of, say, 30%, then I'm going to just take 70%. That's going to be my cost of goods sold. I'm not going to put a whole lot of work and time and effort and precision into that estimate. If your gross margin bounces around a lot, then let the forecast bounce around a lot. And then begin to look over time and see what is causing that to bounce around. Is that real live margin changing month to month, or is that just accounting that's causing that to happen? And then with operating expenses, in a small business, I generally just I'll have maybe 10 lines of operating expenses in my P&L, and I'm just going to make an assumption, a one number assumption for what each of those expenses is going to be. I know what employee expenses are going to be because I got a plan and I'm working the plan, so I'm going to just drop that in there. I know what rent's going to be, so I'm just going to drop that in there. I know what my share of healthcare costs and other things are going to be. I'm just going to drop that in there. And if I'm not exactly sure what they are, I'll just be a little conservative in my estimate. So I generally, in a smaller business, will just identify the various one number for those operating expense assumptions. Now, where it gets a little more complicated, especially if you hadn't grown up in the financial side of the business or are not kind of intimately familiar with the P&L, balance sheet, and cash flow, this is where you got to make some assumptions that you're going to have to. There's going to be a little learning to go along with making these assumptions. So with accounts receivable, DSO is a great measure. It's days sales outstanding. It's basically, it says about how many days of sales on average are sitting in receivables. So as an example, if you recorded revenues, you sent out invoices for $200,000 one month, and you generally give your clients 30 days to pay, then we would expect accounts receivable on the balance sheet to be approximately $200,000. 1 month, basically, of revenues. And a lot of people make a big cash flow mistake by not paying attention to accounts receivable. So you got to be on that, and DSO is a great measure. Inventory is another one where cash can leak out the back door. So if you got to buy a product, pay for it, have it sit around until you sell it, monitoring the number of days on average of inventory that's sitting on your balance sheet is a great measure. And this is a great one too to look at. Is it going from over the last 6 months, has it been going up or has it been going down or staying even? A lot of times what happens when I pull up a company's balance sheet, if I'm doing some consulting work, I see that number drifting up and I can tell that someone's not paying attention. They're letting too much inventory, too much cash go out the door to provide or to stock inventory even though it's not moving, and then they're wondering, I wonder why cash is so tight. So with capital expenditures, we got to have an estimate for that because that's an important driver of cash flow. And generally speaking, I'm just going to look and consider our general big picture plan around capital expenditures. You know, when we're buying equipment, we're spending $50,000 on equipment, that's a capital expenditure. That's not something that we're expensing in the period in which we buy it. And I'm just looking at a plan. You got to have a big picture plan of what you expect to spend on capital expenditures in any given year. So I just plug that number in. Now, when I'm plugging in my assumptions about accounts payable and accrued liabilities, I use days of payable outstanding. It's a very similar concept to DSO and the DIO. It's basically saying just on average, how many days of expenses do you have sitting in payables? For a lot of people, that'll be anywhere from, say, 20 to 30 days or so, but it's another one where it's an easy two-number approach to creating that assumption, and it's a great one to watch the trend, because sometimes what happens if a company gets in trouble, they start letting payables get high, which is not a good thing, by the way. I'm a believer that you want to pay everybody on time or early. And it's generally a sign of a cash flow problem if you're letting that go up. Other assets and liabilities kind of depends on the nature of your company. Oftentimes a percent of revenue is a good driver there. And then with either debt or equity, if I'm raising debt, borrowing money, or selling a portion of the company, then I've got some kind of plan around that, and I'm generally going to use just one number. When I'm sitting down with either forecasting software or a spreadsheet to actually create the actual income statement, balance sheet, cash flow forecast. Okay, one thing I just want to put out on the table right now is that when you're going through that actual creation process, especially if you're not intimately familiar with income statement, balance sheets, and how they relate to each other, there's going to be some learning that you got to do there. And so what I'd like you to do is go to the book, read chapter 4. It's a recipe for financial forecasting. I go through each one of these, and you're going to have to go through that a couple times because this is the part where you can get hung up if you're not familiar with some of these concepts and terms and methodologies. So take a few minutes, read that in depth, and if you come away with questions or if it somehow slows you down from getting started, I want you to make sure you send me an email so that I have an opportunity to try to get you on the right track.